As of the close of the market on Friday, May 8, 2026, Grab Holdings Limited, trading under the ticker symbol GRAB on the Nasdaq, finished the session at a price of $3.72 per share. This represented a daily decline of 1.85%, reflecting a subtle cooling off after the significant volatility seen earlier in the week. While the broader market indices like the S&P 500 showed a mix of caution and resilience, Grab specifically faced a technical resistance level near the $3.80 mark that it struggled to breach in the final hours of trading. The intraday low touched $3.66, suggesting that while the long-term sentiment is shifting toward a recovery, short-term profit-taking remains a dominant force for retail traders. Interestingly, despite the red finish on the daily candle, the after-hours activity saw a slight uptick of 0.28%, pushing the price to approximately $3.73. This minor rebound indicates that institutional eyes are still closely monitoring the entry points, looking for value even when the headline numbers seem lackluster. The expectations surrounding Grab for the last several quarters was a narrative of endless cash burning and the struggle of a regional super app trying to prove it can actually generate a profit in a fragmented Southeast Asian market. However, the reality that surfaced just days ago has completely flipped that script on its head. On May 4th, 2026, Grab reported its first quarter earnings, and the results were nothing short of a massive shock to the system. While many on Wall Street were bracing for a break-even scenario or a narrow loss, Grab delivered a massive earnings beat, posting an earnings per share of 3 cents. To put that in perspective, the consensus estimate was sitting at roughly 0.0188 cents. We are talking about a nearly 60% beat on the bottom line. Revenue also came in strong at $955 million, surpassing the $921 million forecast. This is the moment where the expectation of a struggling startup met the reality of a disciplined, high-growth financial machine. If you were using investing sites to track your portfolio, you probably noticed the sudden spike in volume immediately following that report. The reason this matters so much more than a typical earnings beat is that it proves Grab's business model is finally hitting the economies of scale that investors have been waiting for since its SPAC merger years ago. When we look at online investing trends right now, there is a lot of noise about high interest rates and inflation, but companies that can grow revenue while simultaneously expanding margins are becoming the rare jewels of the tech sector. Grab is no longer just a ride-hailing app. It has evolved into a comprehensive ecosystem where a single user might use the app for a taxi in the morning, food delivery at lunch, and a digital bank transaction in the evening. This cross-pollination of services is what drove that $955 million revenue figure, and it's why institutional activity has ramped up so aggressively in the last few days. Looking at the intraday movement from the most recent session, we see a tug-of-war between those who bought the post-earnings dip and those who are still skeptical of the long-term regulatory environment in Southeast Asia. Trading volumes reached over 52 million shares, which is a significant level of participation compared to its historical average. This tells us that the smart money is actively repositioning. If you look at platforms like Interactive Brokers or the Interactive Brokers platform, you can see the depth of the order book showing a significant amount of support around the $3.50 to $3.60 range. This suggests that the market has established a new floor for the stock, moving away from the penny stock territory it flirted with in previous years. The institutional activity, including a recent 28.9% increase in holdings by the Principal Financial Group, shows that major funds are no longer viewing this as a speculative play, but as a legitimate core holding for emerging market exposure. When we talk about investment help and choosing where to put capital, the comparison between Grab and its Western counterparts like Uber or Lyft is inevitable. However, the reality is that Grab operates in a much more complex and high-growth environment. The Southeast Asian digital economy is projected to continue expanding at double-digit rates, and Grab's dominance in 8 countries gives it a moat that is incredibly difficult to replicate. This isn't just about moving people from point A to point B, it's about becoming the digital layer for an entire region. This is where the tension between expectation and reality becomes most visible. The general belief is that Grab is just a local Uber, but the reality is that its fintech arm, which includes digital banking licenses in Singapore and Malaysia, could eventually become more valuable than its transport business. If you are managing your own individual brokerage account, or perhaps using SoFi Invest for your trades, you have to consider the macroeconomic pressures that have kept the price suppressed. The US dollar's strength has traditionally been a headwind for companies earning in regional currencies like the Indonesian rupiah or the Thai baht. But in this most recent quarter, Grab managed to outpace those currency fluctuations through sheer operational efficiency. They have slashed incentives for drivers and consumers, a move that many thought would lead to a loss in market share, but instead the user base remained loyal. This proves that the brand has achieved top-of-mind status. It's no longer about who is the cheapest, it's about who is the most reliable. This shift in consumer behavior is a massive win for long-term profitability and something that self-investing individuals should keep a close eye on. Now, I want to hear from you. Comment below how many shares of Grab you currently hold, or if you are waiting for a dip back to the $3.50 level before you enter. Do you think the expansion into digital banking is the right move, or should they stay focused on their core transport and delivery services? To understand why Grab is moving the way it is today, we have to look at what this company actually does on a fundamental level. Founded in 2012 as a taxi booking app in Malaysia, it has grown into a super app that serves over 500 cities. Its business model is built on 3 pillars: mobility, delivery, and financial services. The delivery segment, which includes GrabFood and GrabMart, was the hero during the pandemic, but the mobility segment is the high-margin cash cow that is currently fueling the recovery. By integrating these services into one app, they lower the cost of acquiring customers. Once someone is in the ecosystem for food, it is very easy to convert them into a digital bank user or a frequent ride-hailing customer. This synergy is what allows Grab to report revenue growth that consistently beat analyst estimates. The recent acquisition of delivery heroes Foodpanda business in Taiwan is another strategic move that signals their intent to dominate the Asian landscape. While Taiwan is a competitive market, it adds a high-income user base to Grab's portfolio. This expansion reflects a reality where Grab is no longer just defending its turf, but is actively seeking out new growth vectors. For those using investing sites or looking for online investment opportunities, this kind of aggressive yet calculated expansion is exactly what you want to see from a management team. They are not just sitting on their cash, they are deploying it where it can generate the highest return on investment. Speaking of cash, the company recently announced a $400 million share repurchase program. In the world of corporate finance, a buyback is the ultimate signal of confidence. It tells the market that the management believes the current price is undervalued and that they would rather invest in their own shares than anything else. When you see this combined with a 60% earnings beat, it creates a powerful catalyst for a sustained upward trend. If you are tracking this on the Robinhood app or using Robinhood stock trading features, you might see the analyst buy ratings starting to pile up. The narrative is shifting from will they survive to how big can they get. However, we must also address the risks. The reality of operating in Southeast Asia means dealing with varying degrees of political and regulatory instability. Changes in labor laws regarding gig workers could impact margins, and competition from players like GoTo in Indonesia remains fierce. But even here, the reality is exceeding expectations. Grab has shown a remarkable ability to navigate these local nuances, often coming out on top due to its superior technology stack and deeper pockets. Their Grab Maps technology, for instance, provides hyper-local routing that global competitors simply cannot match, giving their drivers a significant efficiency advantage in the crowded streets of Jakarta or Manila. For the future outlook, we have to look at the catalysts on the horizon. The full launch of their digital banks, GSS in Singapore and its counterparts in Malaysia and Indonesia, represents a massive untapped opportunity. If Grab can successfully convert even 20% of its existing user base into banking customers, the interest income and transaction fees would be transformative for the balance sheet. This is the intelligent portfolio play of the decade for the region. As we move deeper into 2026, the expectation will be for Grab to maintain this profitability. The challenge will be doing so while continuing to grow revenue in a potentially slowing global economy. If you are looking at Fidelity or using the Fidelity mobile app to check your ETFs and mutual funds, you might find that many emerging market funds are increasing their weight in Grab. This institutional backing provides a safety net during periods of market volatility. Whether you are using interactive brokers for high-frequency trading or just starting with the SoFi trading platform, the lesson here is that Grab has moved into a new stage of its life cycle. It is no longer a speculative moonshot. It is a maturing tech giant that is finally starting to deliver on its promises. In summary, the story of Grab Holdings Limited right now is a perfect example of the tension between a skeptical market narrative and a much more robust financial reality. We started the week with expectations of a modest performance and ended it with a massive earnings beat and a clear path to sustained profitability. While the share price at $3.72 reflects some short-term hesitation, the underlying fundamentals tell a much more bullish story. The company is leaner, its revenue is more diversified, and its management is showing a high level of fiscal discipline. The transition from a ride-hailing app to a financial ecosystem is well underway, and for those who understand the value of a dominant regional platform, the current price levels offer a very interesting entry point. The expectation was struggle, the reality is a breakout. As always, maintain a disciplined approach to your individual brokerage and keep your eyes on the data, not the noise. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, outshare with your friends, bell notifications for more updates.